Hi, this is February 9, 2011. A hard day on the markets, but where are we? And it's quite some time since I did my last video, which was in December when I was actually looking at a short-term pullback in the market. At the same time, I also highlighted the inflationary cycle which was coming, especially from the global perspective. That cycle continues. The commodity price cycle continues to be bullish and probably will be for at least several months to come. In the short term, our markets are at a point where they're extremely deeply oversold. So I think we are very close, or probably already at a potential medium-term bottom. Whether this medium-term bottom will turn out to be a short-term one for an X wave before we fall again, or whether it will be the start of further move up, that's something that we'll have to wait and see, because it will be a function of how this rally actually unfolds. If you do get a rally, if it's a three-wave pattern, then it's definitely an X wave, and then we would be looking at the market falling probably to 15,000 in the coming months. But if you do get an impulse on the way up, then probably further reactions in the market to the downside would be limited to the current low that we actually make in the next couple of days as we form a bottom. Like I said, the readings are extremely oversold. The mid-cap index relative strength is down to below 20 and very low. The RSI for the Sensex is also oversold for a potential positive divergence. So, and yes, the breadth, the AD ratio, which was giving me negative divergences all of last year when the index was still below 18,500, and I was expecting us to be, the markets to remain below that because of the inflationary cycle. That AD ratio has continued to fall, and now while we are back at the 18,000, in fact 17,600 levels, the AD ratio is actually oversold and showing a positive divergence. So, which is why this current fall is actually leading to a bottom that could be more significant in nature, and we could see a good medium-term bounce back once the selling is done. So sentiment indicators and momentum indicators, both of them telling us that something could form over here. We are in extreme readings. The question really, therefore, which will be left in our minds till we get a further confirmation on whether you get an impulse wave or not, will be whether you're in a deeper bear market or you're really correcting a longer-term bull market. I think that's the question which will remain unanswered for a little more time. In my last long-short report, I did offer three alternates. The second one being that the entire rise from the 2008 low would break up into the fifth on the Nifty. That alternate stands ruled out because the fifth wave of that pattern in my counts did not form, and now that we've overlapped with the April-May highs of last year, most probably it's the first and the last alternate, just two alternates that are left. The first one being the bear case, in which the markets have not really gone past the 2008 highs, and it means that you're into a multi-month decline, which would keep testing previous lows and maybe even the all-time low that we saw 2 years back. And the bullish case, which simply means that we are looking at a retracement correction to this entire rise, and after that the upward trend would continue. Now what's interesting is that on the longer term charts, the monthly charts, we have already reached the mean, which means the 20-month average, which is also around the 17,500 mark. And that can often end up being a significant support to a continued uptrend. So if we are in a bullish market, in a longer term bull trend, this is a good potential point at which you can actually get a low that holds on for maybe several months. it's possible that of course you stay in a trading range maybe between 17,500 and 20,000 for maybe 3-4 months, maybe up till May, before you really get a larger move on the upside. That will allow monthly momentum cycles to actually complete themselves. It's also possible that if any rally from here develops as a corrective, that you get a further sell-off after that, maybe after the budget, and actually head towards the lower Bollinger Band on the monthly, which would be then a much deeper level closer to 15,000. Are we going there? Like I said, we'll only know that once you get a pullback rally and closer to the budget, you should be able to identify whether it's a three-wave rally or a impulse. However, what's interesting is that the Bollinger Bands on the monthly charts have actually contracted over the several months that the market stayed at in a higher trading range. This contraction has pulled up the lower Bollinger Band to a much higher support range. Now, while there are a lot of similarities between what happened in the 92-94 period, the last significant multi-year business cycle, when the markets retest after Harshad Mehta high of 4,500, the Sensex retested it and in fact surpassed it up to 4,600 in 1994. A lot was similar to today. You had weaker performance in mid-caps, although mid-caps were hot into the 1994 highs. And after that, the business cycle turned down. There was an IPO boom that sucked in a lot of money, and then you went into a multi-year trading range, and a lot of sectors, a lot of stocks went into much deeper bearish cycles. Is the same actually repeating here while you've got a double top between 2008 and 2010? The one difference, while momentum indicators are on the sell side right now, the daily and weekly and monthly time frames, the one difference is actually the monthly setup on the Bollinger Bands and the 40-month average. This setup is very different. In 1994, you had an extremely wide trading range on the band itself. So when the markets headed to the lower Bollinger Band, it was significantly a much lower level from the highs. This time around, the level is much higher, and therefore similarities are probably with somewhere in 1984 when the market actually consolidated at a higher trading range and continued to move up. So that does away with the potential comparisons with 94. The other comparison with 94 would be that from a Kondratieff wave perspective. Now, what can happen, what does happen is that 1994, if you've read the Kondratieff wave article that I put up on my on Indiacharts.com, the Kondratieff summer actually ends with a high inflation and high interest rate scenario, and then the markets consolidate for several years, which is what we saw in the 90s. And then you enter the autumn. Autumn starts on low interest rates and low inflation rates, and it actually appears that inflation is under control till debt levels really become extremely high. Now, once that's happened, it's expected that in a Kondratieff winter, you would get deflation or at least unwinding of debt. Until that happens, markets remain bearish, which is why the original article that I wrote appeared to be very negative on what was expected from the 18,500 levels. Also, it highlighted that India's fiscal deficit was a major concern, which it would continue to be next year. This year, the numbers might appear low because we've temporarily financed them through the sale of public sector shares, but we continue to have high debts, and the fiscal deficit could again be high for next year till we find further financing. So, what happens to our Kondratieff wave cycle? Do we actually enter a winter, a deflationary winter? From the American example, we can see that it's possible to extend Kondratieff autumns, but that requires intervention from financial institutions like the RBI, and it requires the support of government towards such an extension through measures that can actually extend the Kondratieff autumn. What would that be? Just looking at the American example, it's actually been possible. In fact, America and Europe, we've seen extension of quantitative autumns despite high levels of debt, simply because it was backed by institutions that actually participated in keeping bubbles from unwinding, which means through some form of financial intervention. And second, they were able to do it because they kept inflation rates low through globalization, by actually moving manufacturing overseas, and therefore they could maintain low interest rates and low inflation for an extended period of time. And because globalization is a reality today, it's actually possible that a global quantitative wave cycle actually is in place, and you can get an extension of these cycles at a global scale till you hit the wall at a global level on that cycle. That would require a completely different study. So at a domestic level, it's possible if governments actually intervene, and allow the economic growth cycle to actually continue, and are able to balance growth and inflation levels, they can actually extend the autumn. But yes, if you see in the recent government uncertainty, it raises the risk bar for deflationary cycle to set in and for the quantitative autumn to take place, exactly as highlighted in my report a year back. So what's the need of the hour? If the quantitative autumn is actually to extend in India, which means the market should hold the 17,500 level that they broke a year back. If that's to happen, we're really looking for clues from the government, which is why I guess the coming month or months and this budget would be very important in providing direction, because if they fail to, then it would definitely mean that we are headed into a quantitative winter-like situation. If the events are similar like the 90s, where the paralysis in terms of economic events at the government level led to us having coalition governments for several years. If the same pattern from 94 to 2000 were to repeat now, when our debt to GDP ratio is several times higher than what it was 15 years ago, the results will not be the same. I don't think you can end up in a trading market for several years. You would actually end up in a much deeper bearish market if that happened. So if our governments do realize that, I guess they would intervene and allow for a quantitative wave autumn extension. And in that case, what the markets could do would probably be, like I said earlier, a consolidation between 17,500 and 20,000 all the way into May of this year, and then potentially break out to a higher level. If we do not resolve the issue soon, probably a bear market rally into the budget and then a sell-off maybe to 15,000 by May, and then a turnaround from there. So those would be the bullish alternates. The unfortunate one would be if you do end up with economic paralysis at the center, then we do end up in an Indian quantitative winter, which would last maybe for a year or two or more, which would be very painful to actually go through. So I guess with that I've covered a lot of what I've explained in my quantitative articles, the long-short report, which has discussed the alternate wave scenarios, and also a comparison with what happened in 94. And I guess before I sign off, let me also highlight what's happening at the global level. I did mention that we're getting an extension in the inflationary cycle globally. Commodity prices are in a bullish cycle that could be around for several years. And what has happened in the US markets is that between 2000 and 2008, I believe they formed an expanded flat, an ABC corrective, which ended in 2008, and what you're getting from there is probably a longer term impulse wave structure, if not a corrective wave which would be part of a multi-year expanding triangle. Now I've actually raised the bar for the first alternate, which is the beginning of an impulse wave, and this and a lot of what I've said today has been possible because of very two interesting readings, two books that I would probably like to highlight that you may actually consider. The first one is a book called Inflation, written in the late 60s or early 70s by Irving Friedman. It identifies how people react to persistent inflation, and that has been around for so long that people tend to believe that as long as there's growth or there are jobs, they're okay with some level of inflation. So that's become deeply ingrained in our system, and people don't generally, you don't really get a social revolution against inflation unless the rates are really very high. Which is why a lot of people that you would have spoken to maybe in the last couple of months are comfortable with the recent inflation levels in India, even though they appear to be high, because higher incomes and the existence of jobs and growth make them feel that it's all right. And the second book, Capitalism 4.0 by Anatole Kaletsky, that actually helps you understand that there could be a huge variation between how the deflationary economic cycle occurs and how the stock markets react in the same period of time. And third, that the financial reaction of financial markets to this, to all of this, can actually be contained even through a deflationary cycle through government intervention, something that is often overlooked. And because you had government intervention in 2008, the comparison of 1929 with 2008 and the expectation that just because Dow fell 90% back then, that the Dow should fall all the way to maybe 1,000 or 4,000 or some odd number like that is not a necessary event. Meaning that while the deflationary cycle even in the 30s was considered to continue till 1940 or a little after that, because unemployment rates remained high and it took time for GDP to actually come back to and surpass significantly the earlier levels, such that debt levels declined. The same could even happen now. The markets way back bottomed in 1932. The Dow was at 30 in 1932, the lowest level, and continued to rise from there in 2 years, going up 4-5 times from that level, and rising over several years, though it did have interim recessions from time to time. The trend of the index itself was upward on an absolute basis, not comparing with the commodity adjusted or inflation adjusted rates. Similarly, it's possible that the Dow has already made its low in 2008 and it's into an impulse wave structure on the way up. Once complete, yes, it could see a deeper retracement, and whenever that happens, you would see the continued deflationary effects of unwinding of debt and maybe whatever that the Kondratieff requires to complete. But that does not necessarily mean that the markets would make new lows below the 2008 lows. So that's I think that's the key point that you'd be able to understand with a lot of depth from the second book that I mentioned. So you could actually look at reading that and getting a good picture of history versus what happened. And in fact, that's also history, the recent history, and the history of the previous cycles, and the role of government in all of that. So, which is why you heard today in my note the importance of what the government does over the next 2 months, in whether India actually completes an entire painful economic winter, or whether we can actually get nothing much more than a deep correction and then a continuation of the upward trend. So that's all from me, a very detailed long update February 2011. Indiacharts.com has not been updated this week since I'm traveling, so probably I'll be able to update it only the coming Monday. But I hope this has given you enough insight over what is expected in the coming week. Thanks.